BigBear.ai stock is up over 46% in the last month, getting investors really excited about this artificial intelligence company. And they want to know what's going on with this stock. Is it still undervalued or is it overvalued? I'll answer some of those questions in this video and provide you some details on what's going on with BigBear.ai stock after a brief message from my sponsor.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
As I mentioned in the introduction of the video, over the last month, BigBear.ai stock is up over 46%, now trading at $8.11 per share as I'm recording this video. But I wanted to provide some detail from the company's most recently completed quarterly conference call with Wall Street analysts on the latest developments at the company. Remember, the company raised some capital selling shares and building up its war chest. It now has $390 million in cash, and according to management, they want to use that money to aggressively pursue new growth initiatives. They intend to deploy capital with urgency, rigor, and discipline to grow their top line both organically and inorganically through a potential merger or acquisition. So when this news came out, it wasn't very exciting to Big Bear AI stock investors. The company had been deploying a lot of capital already, finding it difficult to generate organic revenue growth. And in the most recently completed quarter, they disappointed investors with less than stellar revenue growth, to be sure. But in the last month, interest rates are declining, and interest rates declining are positive for stocks because investors have choices on what they can do with their money. And if interest rates are falling, you're getting less money for putting your money in a money market account or a savings account or a government bond. But that makes growth stocks a lot more attractive, and especially growth stocks that have cash flow expected in many, many years in the future. And that's the case with Big Bear AI. Let me share with you my proprietary discounted cash flow valuation model for Big Bear AI. And the company's losing cash flow, it's negative, and it's expected to be negative for the next few years, according to fiscal.ai. When I looked at the aggregated estimates of the Wall Street analysts that are following Big Bear AI stock, they expect this company will generate negative 320 million in free cash flow in the fiscal year that ends in December of 2026 after generating negative 1.1 billion dollars in free cash flow in 2025 and then generating negative 570 million in free cash flow in 2027. So many years of negative free cash flow expected for BigBear.ai. And these kinds of companies, when their free cash flow is not expected to turn around until many years in the future, or when most of the value of the stock is based on free cash flow expected many years in the future, they benefit greatly or much more when interest rates are declining because the present value of those cash flows expected way in the future are now worth a lot more. So that's why companies like Big Bear AI have seen a surge in share price in the recent month. Another company that follows the similar characteristics is Tesla, right? A lot of the valuation for Tesla is based on cash flow that's not expected until 10, 15, 20 years in the future when the company actually has a driverless car product in the road generating revenue and actually starts selling some of its potentially starts selling some of its robots and generating some revenue. It's not based on valuation from car sales, which are declining and worsening. So that's why Big Bear AI has seen a nice share price increase over the last month. But is that stock still undervalued or is it overvalued? Well, according to my calculations, Big Bear AI stock is significantly overvalued, actually. The current market price is $8.06, and the intrinsic value per share I calculated is only $1.34. Now, the present value of all of the cash flow I expect Big Bear AI to generate is $516 million. And you can see the estimates in my model here. I'm forecasting, according to the Wall Street analyst, negative 570 million in free cash flow in 2027. And then from that point onward, I'm forecasting that the company turns things around in 2028 and generates positive cash flow of 150 million and then more than doubles to 360 million and continues increasing from that point onward all the way up to 550 million by 2034. So the discount rate I'm applying to those future cash flows is a relatively high 22% because the company's beta is 3.15. And remember, beta is a measurement of risk, and this is calculated based on the company's price movement against the S&P 500. So it's looking at historical data and the price movement as it relates to the S&P 500. And then I add a risk-free rate of 4.1% and a market risk premium of 6%. I put that all into the capital asset pricing model, which arrives at the cost of equity of 23% for BigBear.ai. That high discount rate, coupled with the company's negative cash flow and slowly increasing free cash flow expectations, is primarily what's arriving at an intrinsic value that's well below the company's current market price. The share price is up almost 15% today, even though the market overall is down significantly. So I know a lot of Big Bear AI stock investors are happy about that, and I'm happy for you. I know this is a really popular stock among retail stock investors because of the company's lower share price. It's less than $10 a share, making it more accessible, and it has AI in the name, and AI stocks are the most popular stocks in the market in 2025, and they have been since 2023. But in my opinion, this stock looks overvalued at the current market prices. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.